Hey everyone! Right now, Bigbear.ai, trading under the ticker symbol BBAI, is sitting around $7.16 per share, marking a modest intraday gain of about 0.8%. But if you've been following this company, you know that the daily price move is not the real story here. The real story lies in the massive gap between what Wall Street analysts think the stock is worth and what the market itself is currently saying. Let's unpack that for a second. The average analyst price target for Bigbear.ai stands at just $4.85. That's more than 30% below the current market price. Think about that. Analysts are saying this stock is overvalued by nearly a third. That's not a rounding error. That's a flashing red signal of disagreement between investors and analysts. So the million-dollar question becomes, who's right? What does the market know that analysts don't? Or what are analysts seeing that the broader market might be ignoring? That tension between optimism and skepticism is exactly what makes Bigbear.ai one of the most fascinating and volatile tickers in the AI space right now. Across social media, Reddit threads, and retail trading communities, there's a popular narrative building. Many traders believe Bigbear.ai is a sort of mini Palantir. In other words, they see it as a smaller, earlier stage version of a company that could someday command similar prestige in artificial intelligence for defense and government intelligence contracts. The dream scenario? That this little company is sitting on a launch pad to become the next great AI success story. A ground floor opportunity that investors will look back on years later and wish they hadn't missed. But here's where things start to get tricky. When you strip away the hype and dig into the financials, the picture looks far more complicated. The company's most recent major financial disclosure, the second quarter earnings report from August, delivered a reality check that rattled even some long-term bulls. Instead of showing explosive AI-era growth, Bigbear.ai reported that revenue fell 18% year-over-year, landing at just $32.5 million. In a time when every company with AI in its name seems to be reporting 30, 40, even 50% revenue growth, an 18% decline stands out like a warning flare. It suggests that Bigbear.ai isn't just struggling to accelerate, it's actually losing ground. And that's not the only concern. The company also logged a staggering net loss of $228.6 million for the quarter. That's not a typo. That's nearly $250 million lost in just 3 months. The management team responded by taking some drastic steps. They slashed full-year revenue guidance from a previous range of $160–180 million down to just $125–140 million. On top of that, they completely withdrew their EBITDA guidance, essentially admitting that they no longer had a clear path or timeline to profitability. The official explanation pointed to a slowdown in U.S. Army program spending, and that's critical because the Department of Defense is one of Bigbear.ai's main clients. When government contracts slow down, the company feels it instantly. All of that paints a picture of a company under serious pressure. Yet paradoxically, the stock price has remained surprisingly resilient. So, what's driving that strength? It really comes down to 3 main forces: future hope, sector-wide AI enthusiasm, and a massive short interest that keeps fueling volatility. Let's talk about that short interest, because it's one of the biggest stories surrounding BBAI. According to recent data, a whopping 76.7 million shares of Bigbear.ai are being held short. That's more than 17% of the stock's free float. For context, anything above 10% is considered high. When you see 17%, you're looking at a battlefield between bullish retail traders and large institutional short sellers. What that means is simple. A huge number of professional investors are betting that this stock's price will fall. Their argument is logical. They look at the company's shrinking revenue, its massive losses, and its very high price-to-sales ratio, around 13x, and they conclude that the valuation just doesn't add up. In other words, they think Bigbear.ai's share price has gotten far ahead of its actual fundamentals. But here's the twist. High short interest cuts both ways. It also creates the potential for explosive upside through what's known as a short squeeze. That's when even a small piece of good news forces short sellers to buy shares to cover their positions, which in turn drives the price up rapidly. So yes, the stock could crash on bad earnings, but it could also rocket upward if a single big contract or partnership announcement lands unexpectedly. That's why BBAI is such a magnet for active traders. It's a perfect cocktail of risk and potential reward. Now, if you want to track these dynamics yourself, there are 2 key metrics to watch: short interest percentage, and the borrow fee rate. You can find both on data platforms like Ortex or Fintel, or even through many retail brokers. When the borrow fee starts climbing sharply, it means fewer shares are available for shorting, which can create a squeeze-like pressure cooker. But a fair warning, chasing a short squeeze can be extremely risky. You might end up buying right at the peak, just as early short sellers are closing their positions. The current days-to-cover ratio for Bbai sits at 0.47, meaning short sellers could theoretically close out their positions in less than half a trading day, assuming normal volume. That low figure suggests that unless there's a massive buying surge, a prolonged multi-day squeeze is unlikely. So, what does Bigbear.ai actually do? What's behind all this excitement and controversy? Bigbear.ai develops AI-powered decision intelligence systems. In simpler terms, the company builds software platforms that collect and analyze enormous data sets, from satellite feeds, logistics systems, military sensors, or intelligence reports, and then translate that data into actionable insights for decision makers. Think of it as AI designed to help commanders or executives choose between complex scenarios with more clarity and foresight. Its core customers are primarily the U.S. Department of Defense, the intelligence community, and various other federal agencies. In other words, this is a company deeply woven into America's national security infrastructure. They also have a smaller commercial arm that serves industries like manufacturing, supply chain management, and healthcare logistics. That government focus is both a blessing and a curse. On the plus side, it means Bigbear.ai has long-term clients with deep pockets and high barriers to entry. On the downside, it leaves them at the mercy of government budgets, and those can shift suddenly due to politics, defense priorities, or broader economic pressures. In recent months, Bigbear.ai has made headlines for signing several new strategic partnerships, such as the October collaboration with Checkend to develop edge AI solutions for military systems, and another with SMX for projects involving the U.S. Navy. These are the types of announcements that fuel the mini Palantir narrative. But here's the key point. The market wants proof. Press releases are nice, but what investors need to see is actual revenue growth tied to these partnerships. Until that happens, these headlines are more about perception than performance. Another issue that doesn't get enough attention in retail investor circles is shareholder dilution. Bigbear.ai's share count has ballooned by nearly 50% this year alone. That means every individual share now represents a smaller percentage of the company. And it doesn't stop there. Management has asked for shareholder approval to double the authorized share count from 500 million to 1 billion. Why? Because the company likely plans to issue even more stock in the future to raise cash. Given their heavy cash burn and mounting losses, that's not surprising. But it also means more dilution and downward pressure on the stock price. It's a quiet but powerful force that can chip away at shareholder value over time. So at this point, Bigbear.ai isn't just a contest between bulls and bears, it's a tug of war between a great story and harsh math. The story says AI growth and government contracts. The math says declining revenue, high losses, and dilution. Now, all eyes are turning toward the next major catalyst, the upcoming third-quarter earnings report on November 10th. That's going to be a make-or-break moment for the company. Investors and analysts alike will be watching for three main things: revenue stabilization or return to growth. Was Q2's drop a one-time issue, or is it the start of a bigger trend? Cash burn and profitability. Has management found any real progress toward reducing losses or improving margins? Contract pipeline updates. Are the company's new deals converting into measurable revenue? Are backlogs growing or shrinking? If Bigbear.ai can show meaningful improvement on those fronts, even modestly, it could send shockwaves through the short seller community and spark a temporary squeeze. But if the numbers disappoint again, the stock could quickly drift back toward those bearish analyst targets around $4.85, or even lower. Ultimately, this company stands at a crossroads. The promise of AI, defense contracts, and data-driven intelligence is undeniably exciting. But investors can't ignore the very real financial headwinds: declining sales, big losses, constant dilution, and a valuation that's hard to justify. For traders, that volatility can be an opportunity. For long-term investors, it's a test of conviction. So the question is, where do you stand? Do you believe the analysts who see a crash coming? Or do you believe the market, which still seems to think Bigbear.ai has something powerful ahead? Let me know what you think in the comments below. Are you holding BBAI shares right now or waiting on the sidelines until after November's earnings call? Either way, this stock is shaping up to be one of the most unpredictable and closely watched stories in the AI sector this quarter. This is not financial advice.